Hello and welcome back to Ausbiz on this Friday afternoon, streaming to you live from Barangaroo Studios. I'm Gemma Acton and I am joined by another Gemma Dale from nabtrade. Gemma, thanks so much for joining us this afternoon. I think we might start the week by talking about banks. We had the last of the big four banks to come out and give us some results, shed some light on what the situation has been like since the pandemic took over our lives. And curiously, it seems like there's still quite a lot of interest in the bank, despite the fact that there has been a pullback on the dividends. There's been more and more bad news about the amount of home loan deferrals, about the huge amount set aside. Commonwealth Bank setting aside another $1.5 billion in provisions, and yet it's still generating quite a lot of interest amongst your clients.
Yeah, sure. So nabtrade investors have been huge financials holders for a really long time. We know Australian investors have been really enthusiastic about holding banks. A lot of them have held them since they listed, right? When CBA became a public company, a publicly listed company, they were quite enthusiastic about getting on board. Many of them have held it through that period. But it's also been the sector that investors have flocked to when they were looking for yield, as you mentioned. So it has been quite interesting to observe over the last 5 years as the yield has stayed strong, but prices have come off pretty dramatically. So financials are down like 45% from their peak. It's hurt our investors, but they still see banks as an opportunity to hang on to a good quality business. It's still core to the Australian economy. They still believe that the banks are going to be standing at the end of this, that they've made adequate provisions, that they're still going to pay a dividend in the future. So a lot of our investors just see them as an opportunity when there's some price weakness. So this week when CBA came off, it was a 94% buy when it was down 3% during the day. So investors just keep coming back to the banks. They're just not selling them off. It's been quite surprising. There has been a rotation out of banks slowly over the last few years. So they're about 34% of the average portfolio about 3 years ago. It's down about 28% now, but they're still holding them and they're still buying them. And it's not opportunistic in the sense that we're seeing with some of the other stocks. So a lot of stocks we're seeing people buy them on weakness and then get out pretty quickly if they've made a profit. We're actually seeing them hang on. We're just not seeing that profit taking when they come back. So they're pretty keen to hold these for the long term and they're just picking them up when the prices are a bit lower.
And Gemma, we've seen a flood of retailers start to open again, whether it's trial openings or opening up all of their network. How has that been reflected in terms of what your clients have been buying?
We've seen some really opportunistic buying on this front. We know retailers really hurt, obviously, through this period. Having to close your doors has been pretty tough for all of them. Kathmandu came out earlier in the week and said they've seen a real strong shift to online. Our investors obviously thought that was a fantastic opportunity, so Kathmandu was right up there in the top stocks during the week. The other one that blew our minds was Myer. I couldn't tell you in the last 10 years whether we've seen Myer. Obviously, it was taken private for a while and then back on the market. Myer is not the kind of thing we see in our most traded stocks. So investors getting into that, seeing that the reopening is an opportunity for them to lift their profit, obviously, or lift their revenues. I imagine we will actually see quite a bit of short-term trading there. That is not the kind of thing we see our investors hanging on to. They pick it up, try to get a little bit of an upswing in the price and then get out again quite quickly. But I'll let you know in a week or two.
Well, Myer's been quite clever about it because they've done this phased reopening where they've opened 8 stores here and 5 stores there. It keeps on hitting the headlines again and again for being in the news. But let's talk about the payment systems behind them, because Afterpay is a very commonly traded stock. What kind of price action are we seeing there, and with its key rival Zip?
Yeah, sure. So Afterpay is the 10th most owned and 10th most traded stock on nabtrade. Wow. So it has been so popular. Our investors love it. They've been in and out it for the last couple of years. They've had a brilliant time, right? I was looking at the price chart. It's up about 1,100%.
Is it the stories easy to understand? Is it the new face of tech? Is it young and sexy?
Many things. It gives the tech story a bit of glamour. It's very, very appealing to the average investor. So some of our older investors hold it, but it's a lot of the younger investors who go, I know what this is, I use it, I understand the story, so it's clean and simple. NAB as a business invested in it very early on, actually, so we were supporting them, and I think we may have given them a bit of attention and press to our own investor base. It's a really clean, easy story for a lot of our investors to understand. It obviously got hurt really badly when COVID-19 started impacting the retail sector, and this concern about millennials losing their jobs right across the economy, and they're clearly the the widest users of this particular technology. You would imagine that their bad and doubtful debts would go through the roof, and yet we didn't see that. Right. A lot of our investors were buying in when it hit $8. It's back to $40. Tencent's come in with their massive capital injection. So they've had a lovely time, rode it all the way up. They've actually actually been getting out of Afterpay. So they took their profits there, but they have been buying Zip, which is fantastic. So we see them coming back the other way going, this is the other story. Zip has actually outperformed Afterpay over the last 5 years, which is not a story that gets told terribly often. We saw a lot of our investors trying to pick a winner in this sector. So we saw all of this trading between Afterpay, Zip and Splitit at the beginning of last year when Splitit listed. Zip has come through really strongly. They've actually done surprisingly well. And so a lot of our investors have had a lovely time getting in and out of that one. And that's what they've been buying as they've been letting Afterpay go this week.
And what has Zip's trajectory looked like over the last 8 weeks or so since we've been in the depths of this crisis? As you said, Afterpay had an absolute roller coaster, plunged, then zoomed back up again. Yep. But did Zip do something similar?
Very similar, but not to the same extent. So investors have not been quite as active in Zip over the last sort of 2 months. They're coming to it later because Afterpay is much more front of mind for our investor base. Far more of them held it for a start, so they could sell it when they wanted to and get back in. And so Zip, they were actually having to get in later, and that's what we've seen this week.
Now, Gemma, let's quickly turn to international before we leave for the Scott Morrison press conference. But I've got to think about 1920s futurism when I look at what's popular internationally. We're seeing rocket ships, we're seeing fast cars, Tesla, Virgin Galactic. There's a lot of energy behind what people are trading internationally.
Yeah, we see this completely different behaviour when our investors go offshore, so they can buy directly in the US. And when they do that, it really is dramatically different to what we see in Australia. So Australia, we see that real love of quality stocks and then trading at the margin in more volatile things. When they go offshore, they buy stuff with a much more volatile sort of investment behind it. So Tesla is our number one stock offshore, which is kind of amazing to me. It has been up and down like a yo-yo over the last couple of years. They're very happy to trade that actively. Most other things they buy internationally, they don't trade, they buy and hold. So number 2 is Microsoft, number 3 is Berkshire Hathaway. They are buy and hold stocks for our investors. Tesla, not so much, in and out, watching it move around. But the one that you mentioned is Virgin Galactic. We've seen this interest in Carnival, so in these cruise stocks, which is crazy, and we've seen interest in airlines. So this real vulture mentality of getting into these super cheap travel stocks in this crisis. Virgin Galactic, they didn't have to put any of their travel plans on hold because there weren't any. So far, we've pretty much been earthbound. But some of the big brokers overseas were saying that they think Virgin Galactic is still a reasonable story, and we saw investors getting in on the back of it.
I can't help but thinking it's probably the sort of allure of the billionaires as well. They're exciting, you want to be a part of the magic they're creating, the new frontiers they're exploring as well, because we've got 2 big names behind Virgin Galactic and Tesla, of course.
Yeah, so they're very glamorous stocks, very exciting companies, and there is this real enthusiasm for very high tech when people go offshore. As I said, Microsoft is number 2. I mean, that's obviously a technology company that's been around for many decades, but they do have this real enthusiasm for cutting edge technology, the stuff that they can't access in Australia so much, and that's how they do spread the risk across their portfolios. Some of the moonshots, no pun intended, when they go offshore.
Well, it's very exciting. Now going to something a bit more mundane, ordinary, back to the daily life, we're going to switch over to the Scott Morrison press conference. So thank you so much for your time today, Gemma Dale.